The Bible says, be not deceived. Whatsoever a man soweth, that shall he also reap.
All right, it's 4 p.m. on Wall Street. Do you know where your money is?
How much should I invest?
I'm really looking for some direction.
Should I hold on to my house as an investment for my future?
What should we do to have money that we're putting aside?
Welcome to Financial Issues, where we align reality with truth. Conservative talk radio you can count on. Financial issues that you need to know.
We face a disintegrating economy, a weakened defense, and an energy policy based on the sharing of scarcity. We will simply apply to government the common sense that we all use in our daily lives.
Now, here's your host, Dan Celia.
Good morning. Welcome back to Financial Issues. Hey, it's Rapid Fire Friday. We try to take as many calls as we can. You're welcome to queue your call up anytime. Hopefully next segment we'll get to calls, and once we get to them, we'll stay with them. If you've got a financial question you've been waiting to ask all week, maybe something on the economy, maybe something on the numbers that I'm about to go through, and you want to weigh in with your financial questions, questions for me, that's what we're here for. It's Rapid Fire Friday. Rapid Fire means we try to move quickly through all the calls. I would ask everybody and remind you once again that if you can keep your radios turned down when you get on the line, listen. Once you get picked up, stay on the phone, listen to the program, but turn your radio in the background down because it creates a little bit of a feedback to me because I can hear that. So I sure would appreciate it if you do that. And, of course, if you're listening just to the radio thinking that you're going to wait for me to pick up, you'll likely miss me because there's a big delay. So by the time you realize I've picked you up, I've already moved on to the next person. So turn your radio down when listen on the phone. I sure would appreciate it. Rapid Fire Friday, 866-300-9298, 866-300-9298. You know, I looked at my stock picks for the week in light of yesterday. And, of course, yesterday the markets got clobbered. The Dow was down 225, never did recover. The volume picked up there towards the end of the day. I was thinking there may be a little bit of a buying in on this dip, but didn't happen. So I suspect we might see some of it today. Right now, the indices are scheduled to open in positive territory. Now, whether they do or not is another story, but that's what they're scheduled to do right now is to open up in positive territory, and we'll have to wait and see if that happens. I'm not real confident that it's going to happen, but right now indications are. I don't think the data that came out this morning was all that positive. Some do, I don't, and I can go through that and give you some reasons why. Of course, housing starts rose 5.9%, so that's always a good deal when we see housing starts rise considerably for the month of July. So overall, starts in July were up about 20.9% over the same period last year, this time last year. So we see those starts up significantly, pointing to this ongoing recovery that we seem to be having here in the markets, so in the economy. So we'll see. We'll see how long. We'll see if it lasts. We'll see if that picks up, gives any momentum to what has happened. Also, building permits for the last were up as well. Building permits were up 2.7%. Most of those building permits came out as an increase of 13.5% on multifamily housing. Permits for single-family housing decreased 1.9%. So basically, it looks like housing, when we just pick apart housing, it looks like housing's relatively muted compared to the what we might expect to see in light of interest rates, mortgage interest rates moving up slightly. So I think that's good news. Frankly, I'm not concerned about that at all. I am concerned a little bit about the mentality of buyers of homes, that they may be concerned as they see mortgage rates go up. But listen, folks, if you have followed the markets for any length of time whatsoever, then certainly you realize that we are far below the norm for mortgage rates. So I think mortgage rates are going to have to get up considerably higher before I have any concern about where they are. So, let's just, if you're ready to buy, continue to buy. Second quarter productivity picks up. Now, remember, I talked a little bit about this yesterday when we saw consumer price indexes come out. Productivity picks up 0.9%. Productivity for the U.S. non-farm business sector accelerated 0.9 at an annual rate in the second quarter. Productivity continues to increase. The Labor Department estimates came out this morning. Economists were expecting about 0.7%. They got a little bit more than that, so that's certainly going to be perceived as good news. But it's very interesting because one of the key inflationary signals that we look for as we think about inflation entering in, is the rise, the annual rate of labor cost. And the annual rate of labor cost right now is sitting at about 1.4%. Well, that's good. Wages are going up 1.4%. No. That's not what it means. Year over year, wages have declined 0.1%. So we've got productivity increase. And I talked about this yesterday. Productivity continues to increase. And you might think that's good. It's increasing on the same amount of hours worked per week. But the cost of producing whatever whether it's a tire or electronic parts or whatever it is that manufacturing is producing, the cost of that production is up 1.4%. And that does not include wage growth because wage growth has gone down. So if you read into the numbers even a little bit, does that mean health care? Does that mean benefits to employees? Yes, it does. Now, I'm not saying that's the only factor, but we've got an increase certainly in health care, increase in benefits, and there has to be some other increases that are creating this cost because we have productivity going up and wages going down. So very, very interesting. Now, that is considered a positive number that productivity is up. It looks like the economy is picking up, but you've got to weigh that against what wages are, and I don't think anybody's doing that. I'm doing it because you hear me do it on a regular basis. But it's very aggravating to me. We see this CPI going up 1.7%, but we see in yesterday's report coming out of the Department of Labor that real wages have declined 0.1% over the past year. So I'm trying to figure out where all the increases are coming from in production costs if it's not coming from wages. I'm not saying it's all coming from Obamacare or Obama unaffordable care. I'm not saying that it's coming from that, but certainly that's got to be playing a part in it. Treasuries slid back to off its high yesterday. The 10-year note hit 2.82%. 10-year note hit 2.82%, is sitting right now at about 2.79, or we'll just say 2.8 on the 10-year. Nobody seems to be too worried about this. I am, but nobody else is. Because despite the Fed's efforts, it's giving us an indication that the Fed has no control. Fed has no control over what it's doing, right? If it had any control, we wouldn't have this issue. But apparently, it has no control. So we're going to have to watch this, but it doesn't matter because I'm the only one reporting on it. I'm the only one that seems to be caring about it. But Treasury notes going up is of some concern. It's good for savers eventually, but it makes no sense. There's no correlation between what the Fed is doing and what the rates are doing. Municipal bond funds. This week will mark the 12th week in a row where there have been outflows, people running from getting out of municipal bond funds. Fortunately, all of you listen to this program. Many of you are partners with me on the website. You got out long before everybody else talked about getting out, right? You did listen, and you got out. I hope so. So anyway, that's the 12th consecutive week. Let me see. The outflows pulled have been a net $1.2 billion out of immunity funds. Now, here's the thing about that. That is going to have a dramatic impact on state, city, municipalities, sewer authorities, water authorities, school authorities, all those municipal bond funds. It's going to, remember, they're already in a little bit of a fiscal problem and have some fiscal trouble, and that is going to hurt them because now they got to pay up. So you get out of these bonds and they surrender these bonds. The municipality actually has to pay the money out. They don't have the money to pay out, and that's going to impact their balance sheet, going to make their financial situation a little bit weaker. Very interesting article this morning. A fellow by the name of Rex Nuttington, writing for the Wall Street Journal's Market Watch, had a really good article in there this morning, and he was talking about no one's investing in tomorrow's economy. And the premise of the article is this. The biggest problem, and I'm reading from the article, I'm quoting, the biggest problem in the U.S. economy today is a lack of jobs. Well, we all know that, right? The biggest problem for tomorrow's economy is a lack of investment in today. So we've got this lack of jobs, and we've got a lack of investment, corporate investment, to grow jobs later. The U.S. economy, reading again, the U.S. economy simply isn't investing enough to ensure that there will be enough good-paying jobs for our children and our children's children. Net investment. The amount of capital added to our stock remain at the lowest level since the Great Depression. The amount of money going into the market, and in this article, there's a chart going back to 1982, and it shows the net investments since the Depression. So if you start in 1982, the net investments since the Depression was going up, 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 started to come down in 1984, 85, started to come down through 1992, started to go back up. That lasted until about 2000, and then pretty much has been coming down since. And right now it's at an all-time low. It's below 3% as a share of GDP. Back in 1982, it was 6.75%. So what he goes on to say, and this is the only part of the article that I probably take a little exception to. He says it's probable that the slump in investment, the willingness of the American people to get into the markets, the slump in investments is a temporary thing, but a few economists worry that it could be permanent. Well, I would fall into the few. And I'll tell you why. Because back in 2009, I said that the markets have forever changed, and it's why quantitative easing isn't going to work. And because I do much more of a behavioral analysis, I said that baby boomers, who, by the way, control most of the money, most of the wealth in America, baby boomers have had it. This is their third bust, and they're sick and tired of it, and they're getting closer to retirement, and they are not ever going to be aggressively going back into the markets like they had in the past. They've learned a lesson 3 times, and it would be just foolishness to do it again. And I believe that that is still prevalent. That mindset is as prevalent now as it was in 2009. So I believe that we are seeing a permanent sea change in the markets, and I think it's going to take a very, very, very long boom in the markets, in the economy, to see that mindset start to change. So I think it's permanent. As bad as much as traders and Wall Street doesn't want to hear that, I in fact do think it's permanent. We'll have to wait and see. We'll find out real soon, I'm afraid. Interesting stuff. You're listening to American Family Radio Network. It's Financial Issues. I'm Dan Celia. It's great to be here. We're going to get to the phones, 866-300-9298 right after this.